Go through question 15. I don't want any discussion. When I give you time to go through the question, go through the problem, then you start struggling. When I start solving the problem, you start struggling because you're not going through the problem at this point of time. Okay, let's understand this question. The following particulars relate to a scheme. Investment in shares are given. These are the cost value. Information to calculate the market value is based on this. Index on purchase date, index on valuation date. For example, pharma company 260 is equal to 79 crores. What is 465? That's how you will do the valuation. We have done a similar valuation in one of the problem. 260 is equal to 79 crores. What is 465? When we did that problem, they had given only one instrument. Here we have so many instruments, totally some 5 instruments are there. I'll have to end up valuing them using those index values given. Listed bonds, some 12 crores is the value. There's a market expectation. I'll try to link it in some time and understand how we go about it. Unlisted bonds, units outstanding, expenses payable. So we'll end up calculating net asset value of the fund is, before you divide by the number of units, it's called net asset value of the fund. Moment you divide by number of units, it's called NAV per unit. So if you divide, it will become NAV per unit. If you don't divide, that's called as net asset value of the fund. If the period of consideration is 2 years and the fund has distributed, ascertain the net return. Return is going to be NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. That's called holding period return. If you do into 12 by M, you will end up getting the annualized return which is needed. The new concept which you are going to learn is on expense ratio. So that's the only concept which is going to be additional. Working note 1, computation of NAV per unit. Computation of NAV per unit. NAV per unit, particulars calculation amount, particulars calculation amount, computation of NAV per unit. Capital A assets, in assets equity shares, and underline that, assets equity shares, and underline that, we have different investments which have been made by the company, so we take that into consideration and do the valuation. Pharma companies, in pharma companies my investment is 79 crores. When I purchased it, what was the index value? Now what is the index value? 465. So 79 into 465 by 260. You can work with 4 decimals. 79 into 465 by 260, 4 decimals. 141.2885. 79 crores into 465 by 260 in crores. 79 into 465 by 260. When I had made the investment, the index was at 260. Now the index has gone up to 465. My value would have also gone up. Next, construction industry. Construction, 31 into, what's the index value now? 450. When we purchased, 210. 66.4286. 450 by 210. Next is service sector. Same calculation you can keep completing. 56, 480 by 275. IT companies, $34 crores into 495 by 240. Let me know if there are doubts in any of the value here. Let me know if there are any doubts in any of these numbers. Clear? Can we proceed? Any doubts in any of these numbers? Can we proceed? Clear? Okay, so I've done the equity shares investment. I have listed bonds and unlisted bonds. Listed bonds, unlisted bonds. So we have two categories. Shares part of valuation is done. Any extra information on unlisted bonds? Anything mentioned on unlisted? Listed I'll come to in a minute. Anything mentioned on unlisted? If nothing is mentioned, copy the same 7. If nothing is mentioned additionally for unlisted bonds, I end up copying that number of 7 crores. I've copied that number of 7 crores. No extra information is there. Any doubts? Okay, coming to the listed bonds part. 8,000, 14% bond of 15,000 each. So there are 8,000 bond and they are of 15,000 rupees and the overall value is 12 crores. That's what the question has given. What is the rate of interest bond is paying? What are people expecting? So these bonds have to ideally quote at a premium in the market, because bond is paying 14%, people are expecting only 8.842%. The rate of interest paid by the bond is far higher than the expectation of the investor. So such bonds have to ideally quote at premium. Whatever value of 12 crores is given, that's basically the face value or the cost price. I have purchased it at 15,000. Can you tell me what will be the amount of interest on a single bond? Amount of interest for one bond? 2,100. Listen, one bond can pay 2,100 and one bond should ideally quote at 2,100 divided by 8.842%. You would have seen that current yield is equal to interest by current market price. That's the formula we would have used in bond valuation. Current yield is equal to interest by CMP. So CMP is equal to interest by current yield. Interest is 2,100 and current yield is, listen, I would have used this 8.842% in two ways. I can either say that that is the current yield, or I can say that is the yield to maturity. Yield to maturity will come into picture if there is a life of the bond. If you give me a life information, then what I will do is year, cash flow, PVF, DCF, write the number of years whatever is the life, discount the cash flows at 8.842% and get to know what is the price of one bond. Here I do not have any information on the life of the bond. So it is like an irredeemable debenture or a perpetual debt. So for a perpetual debt, I use the formula of valuation of perpetuity. P naught is equal to D1 by KE minus G. P naught is equal to D1 by KE minus G. D1 is replaced with I1, which is interest of the first year. KE is replaced with cost of debt. Cost of equity is replaced with cost of debt, and there cannot be any growth as far as debenture is concerned. So the value of a debenture is equal to interest divided by cost of debt. Interest divided by cost of debt. So 2,100 divided by 8.842% is how much? How much? 4? 2,100, 23,750. So one bond should ideally quote at 23,750. The face value given in the question is only 15,000. So what I am going to do is, listed debentures is 8,000 into 2,100 divided by 8.842%. 8,000 bonds into 2,100. 2,100 is the interest. 2,100 is the interest per bond divided by 8.842%. Any doubts on this? Divide by 8.842%, and in this way my listed bonds will quote at a premium. Because I am paying far higher than what people expect. So people are expecting only 8.842%. I end up paying some 14%. 8,000 bonds into 2,100 divided by 8.842%. You will do again in crores. The valuation will be done in crores. it's broadly 19 crores. The value is around 19 crores. This is a concept of bond valuation which have come in here. I may use also the concept of share valuation if this index information is not given and they say the share is quoted as per Walters model. So, I may have to do the valuation as per Walters model and get to the answer, or they may give a P multiple saying this is the P multiple at which it is quoting. So, shares part was fairly easy calculation. Bonds part we have used the concept of bond valuation. We have used the concept of any other asset in the question. Cash, how much is cash? Cash is 1.5. Total assets expenses. No, those have been already incurred by the bond. I think it says the following particulars relating to Vishnu fund scheme. So, my assumption is investment in shares they have given at cost, investment in bonds they have given some data, expenses payable is going to be a liability, cash and cash equivalences post meeting all expenses, post earning dividend, post paying out dividend, everything done, and the final number is 1.5 crores. Yeah, the closing value is 1.5 crores. We had done a similar problem, but where they specifically mentioned that cash as on 1/4/2005. They specifically mentioned that was a opening cash. And in fact, when I did that problem also, I told you what we are doing is not a logical way of doing it, because expense will not be the only thing. There will be lot other items which will happen. Put a total of the assets. Less liabilities and net asset value of fund. This is the part 1 answer, net asset value of fund. What is the liability given in the question? How much? 3.5. So, NAV of fund is 415 crores. 415 crores is the NAV of the fund. Let me know if there is a doubt in 415 crores. Any doubts in 415 crores? Do let me know about it. Number of units, NAV per unit. Number of units and NAV per unit. How many units are there? 4.2, 4 decimal. So, my closing NAV is going to be 98.9681. It is going to be some 98 rupees. Let me know if there are doubts in any of these numbers. That will answer part 1 of the part 1 and 2 of the problem. Net asset value of the fund and NAV per unit. Net asset value of the fund and NAV per unit. Any doubts on this? 415 crores and 98.9681 crores. Clear? Can we proceed? Any doubts on this? Okay. Now they are saying if the period of consideration is 2 years and fund has distributed 3 per unit, ascertain the net return. Net return is going to be NAV 1 minus NAV 0 plus D1 plus CG1 divided by NAV 0 into 100. I've already got NAV 1. NAV 1 is 98.9681. Technically in this question it should be called as NAV 2. NAV at the end of second year. They have mentioned that 2-year period, but we'll just call NAV 1 means ending NAV and NAV 0 means beginning NAV. That's how we take when we apply the formula. Now I have the NAV 1. I need to calculate NAV 0, which is before 2 years what would have been the NAV. 2 years back what should have been the NAV, that information I have to first analyze and get. Now the scope for a lot of assumption, what ICI has done is, listen for some time, they took those cost values 79, 31, 56, 34, 10, 12, 7, whatever is the cost value given in the question, whatever is the cost value given in the question. So 2 years back it would have been purchased at this level is ICI's assumption. 2 years back with an assumption that there was no cash at that point of time. No cash. I cannot assume what will be the cash position also. It's not possible for me to assume, because through 2 years in the between they have paid some dividends, they would have earned some dividends, they would have earned some interest, they would have paid some expenses. So it's very difficult for me to go back and calculate what will be the cash balance at the beginning of the year, and at the end of 2 years it's 1.5. So they took these numbers, no liabilities, this is the NAV, and this is how they calculated the opening NAV. The opening NAV calculation is, there is scope for assumption, there is a lot of scope for assumption, but ICI solution is very simple. Whatever cost we had, whatever is the cost value given, that was a purchase exactly 2 years back. Now I can even argue on that also, saying that why it is exactly 2 years back. In the interim period also some purchase could have been made. In the interim period also company could have made some purchase. I don't have any data on that. So if I look at 2 years back, it would look like this is the analysis of, is the assumption with which I proceed, and 2 years later this is the calculation. 2 years before, the calculation is pharma company was at 79 crores, construction was at 39, service was at 56, 34, 10, 12, 7, no cash balance, no liabilities, nothing is there, and 2 years back my NAV was 54.5238. I need this number to calculate the return. I need this number to calculate the return. Till now in earlier set of question we have just focused on getting the ending NAV, because the question was not asking us to calculate the return. And even if it was asking us to calculate the return, the opening NAV was given in the problem. The problem which we just now did, there the opening NAV was 10 per unit. So we did 9.9 calculation, subtracted 10. I've done the ending NAV calculation. Opening NAV is going through an assumption, is going through some assumption. Next working note, computation of opening NAV. Computation of opening NAV. Computation of opening NAV. Next working note. Below that, right, it is assumed that investment in shares and bonds was made, investment in shares and bonds was made 2 years back. Bonds and shares was made 2 years back, and there was no cash, slash expenses payable. There was no cash slash expenses payable on that date. No cash slash expenses payable on that date. No cash or expenses payable on that date. Beginning NAV equal to 79 plus 31 plus 56 plus 34, keep adding them. Beginning NAV is equal to 79 plus 31 plus 56, you can show it in your notebook, plus 34 plus 10 plus 12 plus 7 divided by 4.2. 79 plus 31 plus 56 plus 34 plus 10 plus 12 plus 7. No, those are not there. Outstanding bonds, outstanding units remain same. The units remain same 4.2, but there is no cash or no liabilities. That's my assumption. I can make an alternate assumption, solution will undergo a change. So my opening NAV is going to be 54.5238. Any doubts on ending and opening NAV? Now we are going to apply this formula of NAV1 minus NAV0. Whatever return I calculate, that's for 2 years. I'll divide it by 2, I'll get the yearly return. Or in the formula itself, if I do into 12 by 24, the formula is into 12 by M. So if you do into 12 by 24 at that stage, automatically the annual return will come. Without doing that into 12 by 24 or 12 by 1, what you get is called holding period return. What is technically called as holding period return. To get the annualized return, I'll have to do the division or multiplication depending on the period of investment. So return equal to NAV1 minus NAV0 plus D1 plus CG1 this is called as holding period return. Though we keep using D1 and CG1, many questions will talk only about dividend distribution, they may not talk about capital gain distribution. What's the ending NAV? 98.9681. Opening NAV is 54. Dividend is how much? How much? It's 3 per year. It's given us 3 per year. Be careful while reading it. It's 3 per year. I am doing analysis for a period of 2 years. It's 3 rupees per year. 98 minus 54 plus 6 divided by 54. The annualized, the holding period return is coming to 92.52%. That's the number I get, 92.52%. Any doubts on 92.52%? Then annual return equal to 92.52 divided by 2. 46.26%. That's the return the MF is able to generate. 46.26. 46.26%. Any doubts on this? Okay, now comes the newer concept which we are going to learn, which is on expense ratio. Practically, when I'm investing in an MF, I would like to have a understanding of what is the expense ratio of a mutual fund. Why expense ratio becomes critical is, if mutual fund earns 20% and if their expense ratio is 1%, I'll end up getting 19. If it spends 2%, I'll end up getting only 18. If it spends 3%, I'll end up getting 17. SEBI has put a lot of restriction on the maximum allowable expense ratio. So there is a limit on the expense ratio. It's not that mutual fund can keep incurring a lot of expenses. So there are certain limits on the expense ratio to be incurred, and it also depends on how much investments they are making. So it is basically called as percentage of AUM. AUM is asset under management. So asset under management is nothing but how much net worth does the mutual fund has. So your expense ratio in the practical world has some restriction. If it's a smaller MF, the restriction is 2.5% mostly. If it's a bigger MF, if it has holding assets of more than even 1000 crores, 2000 crore, the expense ratio may not be even more than 1% or 1.5%. They do not allow an expense above that, because this expenses finally go and hit the individual. Now, they have said the fund has incurred the following expenses. Now, I have one information which is not very clear, whether this expense is for 1 year or it for 2 years. So, that part is not very clear. I will make my assumption and proceed on that. So, my assumption is this expenses given are for a period of 2 years. Expense ratio is normally calculated for a year. Expense ratio is normally calculated for a year. Next, computation of expense ratio. Computation of expense ratio. Computation of expense ratio. Particulars calculation amount. Point number 1, expenses for 2 years in bracket assumed. Whatever is given in the problem is for a 2-year period. Expenses for 2 years. We'll again do it in crores. 4.8 plus 1.5, 6.68 crores. Two years expenses 6.68 crores. Then expenses for 1 year. Two years is 6.68 crore, 1 year is 3.34. Number of units. Number of units. How many units are there? And annual expense per unit. Four decimal answer. So, every unit 79 paise is incurred by the MF. Now, the problem is the 79 paise goes out from my return. Otherwise, I would have earned a higher return. So, that is why there are some limitation in the practical world on the expense ratio. Now, my expense ratio is normally calculated on average assets under management. Average is basically opening plus closing by 2. ICAI has not given answer to this part, so I am not sure how ICAI is going to present this, but what I am going to do is annual expense ratio, listen for some time, on closing NAV. So, closing NAV was this divided by 98.9681 into 100. So, if I go by closing NAV, it's 0.8%. If I go by closing NAV, which is 0.7952 divided by that 98 point whatever number was there into 100. So, 0.8% is my answer if I go on closing NAV. Same thing on opening NAV is this divided by my opening NAV was 54.5238. Normally, we prefer doing it on average. ICAI has not given any problem on expense ratio. So, there is no problem in your material on expense ratio, and they did not give the solution to this. So, I am not sure what they are going to exactly follow, but in practical world, it is normally on average. So, I am presenting all three possible answers on closing NAV, on opening NAV, on average NAV. So, averages you will take the average of those two NAV and then again do into 100. So, it can be 0.7952 divided by 98, it can be 0.7952 divided by 54, it can be 0.7952 divided by average of these two, which is some 76.746. So you can do it on 98, you can do it on 54, you can also do it on average, which is 76.746. Any doubts on this? Anybody has any doubts on this? Expense per unit divided by NAV per unit, expense per unit. Now what NAV do you take is the question. So I am giving three possible answers: on closing NAV, on opening NAV, on average NAV. We calculated expenses per unit and then divided it by the NAV. That will give me the expense ratio. Expenses at a per unit level, NAV is also at a per unit level. Both are at per unit level. I could have left both at an overall level, then I should have divided by net asset value of the fund. Rather than the NAV per unit, I should have gone by net asset value of the overall fund. 0.8% if I go on closing NAV, 1.46% if I go on opening NAV. Practically average is what works, and that is 1.04%. Average is what works, and that is 1.04%. Any doubts on this? Dividend is declared but not. So if dividend is declared by the, you will consider for D1. Why will you consider for D1 is when you calculate NAV, that would have been shown as a deduction as dividend payable. There would have been a liability. So even if dividend is declared but not paid by the fund, it will form part of D1 calculation, because NAV1, see, the logic is either it should be part of NAV1 or it should be part of D1. If you have declared the dividend, you will show it as a liability in your books. Which one? Return will not change. See, return does not change by dividend declaration. Dividend is of no use as far as MF is concerned. In case you invest in an MF and assume they are not declaring dividends and you want money, you sell some units and come out, that's all. You sell some units and come out. In fact, now dividends are not going to be that lucrative, because what had happened is now there is some dividend distribution tax which has also come in from an MF point of view also. Earlier that issue was not there. Now that has also come in. So if I am an MF investor, I wouldn't want to earn any dividends. I would want to earn return in the form of capital gain, and I'll try to keep my capital gain less than 1 lakh a year if at all possible, because I think 1 lakh is the limit they have mentioned. So if it's less than 1 lakh, I don't pay any tax. Otherwise, I'll have to end up paying tax on dividends. There's no limit. Even 1 rupee declared, there'll be a 10 paise tax. Dividend distribution tax in the end is paid by the investor. It's not paid by the company. Though the company pays that amount, technically it is reduced from my dividend. Else they would have given me a higher dividend if there was no DDT. So dividends are not tax exempt in India's context. They are taxable. They are taxable because you end up paying in the form of dividend distribution tax. Any doubts on this? So 0.8%, 1.46 and 1.04, three possible answer. Practically this is what will work. 1.04%. My annual expense ratio is 1.04%. Any doubts on this? Clear? Can we proceed?